This is my 3-step plan to protect my investments from inflation. With reported consumer price inflation reaching decade highs, and the prices of homes, cars, and other goods rising even faster than that, there is real reason to be concerned about the long-term impact inflation has on your purchasing power. By now, you're likely familiar with this chart of the Consumer Price Index, which has shown that the value of the dollar has decreased by over 92% from 1947 to 2021 today. This inflation is a result of governments continuing to print and spend more money than they have, making the dollar worth less every year. To illustrate the impact of inflation in real time, I actually started a timer at the beginning of this video. Assuming that each second represents a year of inflation at 3%, you can see that even for seemingly small, innocuous rates of inflation, they add up over time to steal a meaningful portion of your real wealth. If this frustrates you or gives you an anxiety seeing this number go down, that's actually a good thing, because it means that you are aware and understand the long-term impact that inflation can have. The next step is then to position yourself and your assets and investments in a way to help mitigate the long-term impact of inflation, and in some cases, maybe even benefit from it. With that, the first step in my investment strategy to combat inflation is to focus on building a large portfolio of quality stocks. Now, this might seem rather obvious at first, as most of us are likely investing the majority of our portfolio in stocks anyway. However, when it comes to inflation, stocks are actually a critical asset you must have in your portfolio if you hope to outpace inflation over time. A key reason for this is that stocks are ownership stakes in businesses, compared to, say, lending your money, in which you may receive a fixed amount of interest and your principal back. Ownership of stocks or equity stakes in companies give you a slice of a business that is likely to grow over time. For example, in the case of inflation, many companies experience a rise in costs in the inputs required to create the goods or services that they sell. In this case, owning quality stocks with pricing power allows those companies to pass on those increases in costs onto the end consumer. This can allow these companies to maintain or even grow profits in an inflationary environment. Take, for example, two of the larger positions in my personal portfolio at this time, Facebook and Alphabet. Both of these companies sell digital advertising and have an extremely strong moat and very strong pricing power. As demand for digital advertising increases, it's very easy for these two companies to simply adjust their formulas for how they price their digital ad spots. As such, it isn't too surprising for me, especially in an inflationary environment, to see these companies post such strong growth in earnings and sales. This is one of the biggest advantages of owning quality businesses for the long term, because generally their businesses will continue to perform well even during periods of higher inflation. Now, just because stocks generally do better than other assets during periods of inflation doesn't mean that they always will. In fact, one key factor for determining the degree of outperformance that stocks usually have in inflationary environments is their relative level of valuation. When stocks are more expensive on a valuation basis, or you have to invest more dollars to receive the same amount of earnings or sales, then the real return of stocks, or the return above the rate of inflation, is generally lower from those higher valuation points. When you can purchase stocks at a lower valuation, getting more earnings or sales for each dollar invested, in those cases you can generally expect better performance from stocks over the medium and long term, especially during inflationary environments. Part of the reasoning for this is that when you have stocks that are trading at low or relatively cheap valuations, as inflation pushes other investors to look for those same stock opportunities, the valuation or price of those stocks will generally rise over time. And if the business continues performing well over time, you benefit from both the increased business performance as well as the rise in valuation. Generally speaking, for these reasons, for most investors, it's probably beneficial to have the majority of your investment assets invested in the stocks of quality businesses. Personally, for me, I'm aiming by the end of this year, 2021, to have 80 to 90% of my investable assets in stocks. Now, what percentage makes sense for you can depend on a variety of factors, including your risk tolerance and ability to stomach short-term price volatility. But over the long term, I think stocks will vastly outperform other asset classes like bonds, especially during periods of inflation. And speaking of bonds, that actually gets into the second step of my inflation strategy, which is to completely avoid long-term bonds. Now, within my own personal portfolio, I've actually taken this a step further, and I don't own any bonds. 0% allocation to bonds of any duration. Now, when it comes to the quote-unquote traditional financial advice, of a 60% stock, 40% bond portfolio, a 0% allocation to bonds might seem a bit extreme. However, I'll explain that at these low interest rates, bonds are actually a very poor investment, and even more so when you consider the potential of an inflationary environment. When you buy a bond, you effectively lend your money in exchange for agreement to be paid that money back later, also called your principal. And in most cases, you'll additionally receive periodic interest payments. However, by their structure and designs, bonds in this form are actually a very poor investment when it comes to inflation. Since we know inflation will continue to reduce the real purchasing power of the currency, the principal payment you get back when the bond matures will be worth less in real terms than when you initially lent it out. This means you must rely on the interest payments to keep up with inflation. If interest rates on bonds are low, like they are today, or if they're lower than the expected rate of inflation over the duration of the bond, then in total, principal and interest payments, the bonds are likely to lose real purchasing power over the lifetime of the investment. For an asset that has effectively 0% real upside potential, that's not an attractive option to me. It should be noted that there's a distinction between bonds, and some are riskier than others. Long-term bonds like 10, 20, and 30-year bonds have the highest inflation risk because there'll be more years of inflation between the time you buy the bond and lend your money and when you finally get your principal back. Short-term bonds, on the other hand, allow you to be impacted by fewer years of inflation before you finally get your money back. If inflation rates suddenly spike up significantly, like they did in the US in the 1970s, long-term bond prices will drop significantly. During the 1970s, the losses on these Treasury bonds were 30 to 50% or more, depending on the length of maturity. This goes against some of the common associations with bonds that they're lower risk or risk-free, but the fact is they're only considered lower risk if you completely ignore the risk of inflation. If you're seriously concerned about inflation risk, you do not want to own a significant amount of bonds in your portfolio unless you believe that they adequately compensate you for that risk. Now, I already know I'll be asked this, so I want to address inflation-protected bonds. These are also called Treasury inflation-protected securities, or TIPS for short. These are bonds that are issued by the government that are linked to the CPI or Consumer Price Index. The idea behind them is that interest payments you receive from them will typically be lower than a traditional bond, but your principal that you receive back when the bond matures will increase as CPI increases, so it can better protect you against sudden changes in inflation. Whether or not this seems like a suitable investment option for you comes down to this single question. Do you trust the government to accurately report the Consumer Price Index to reflect the true level of inflation? You must decide on the answer to this question before you invest in any TIPS. If you invest in inflation-protected securities and it appears that the Consumer Price Index is not accurately tracking inflation, i.e., prices around you appear to be rising faster than what's reported, then you'll lose real purchasing power by investing in those inflation-protected securities. So is CPI an accurate measure of inflation? That's a question I'll have to cover in another video, but I'll leave you with this chart. While the CPI has increased over time, the prices of many other goods and services have increased at a faster rate. For instance, essential services like healthcare, tuition, and childcare have risen at a much faster rate than CPI. Additionally, home prices have risen faster as well, as anyone who's trying to buy a home today can attest to. I personally don't think that Treasury inflation-protected securities are a good tool to combat inflation. However, you'll need to make that determination for yourself. Overall, while you don't need to completely eliminate your bond allocation as I have, you should still seriously consider and compare the risks of owning bonds to the long-term risk of inflation. And finally, the third part of my inflation strategy is more geared towards the tail-end scenarios. And by tail-end, I mean scenarios where we see inflation go maybe much higher than we're really expecting. Extended periods of elevated inflation or runaway inflation have the potential to evolve into hyperinflation, which is an extremely destructive force economically. In these tail risk scenarios, it's possible that even a basket of high-quality stocks might not, at least in the short term, keep up with inflation, which is why I think most investors would benefit from having at least a small portion of their portfolio dedicated specifically to inflation hedges. Examples of inflation hedges can include precious metals like gold and silver, Bitcoin, as well as commodities and energy or material stocks. While these assets aren't going to track inflation from day to day or year to year, during extended periods of elevated inflation, they likely will see significant increases in price. During the hyperinflation in Germany following World War I, gold was one of the few assets that actually retained and increased purchasing power over that time. Similarly, in the modern era, we're seeing Bitcoin being used as a store of value, especially in countries where the government can't be counted on to maintain the purchasing power of their currency. Additionally, one can purchase the stocks of energy or material companies as an inflationary hedge, as those companies will likely see a material increase in profits should the price of the underlying commodity rise significantly. For instance, for the first 7 months of 2021, the best performing sector in the S&P 500 was the energy sector. Personally, I have a long-term target of around 10 to 15% of my portfolio in these inflationary hedges, but that may be a higher percentage than most investors need. When it comes to these inflationary hedge assets, I think most investors would benefit from at least 5%, maybe up to 10% of their portfolio across these assets. Now, that doesn't necessarily mean you have to pick and choose one, though if you have conviction in one over the other, that's certainly fine to do. But it's also perfectly fine to use a mix or combination of these inflationary hedge assets just in case one outperforms the other in different inflationary scenarios. Personally, I like using a combination of precious metal stocks and have recently been looking into adding a Bitcoin allocation. Again, I should stress that these assets aren't something that I would expect a consistent return from. The benefit of their inclusion in the portfolio is primarily to hedge against these tail risk inflation scenarios, and so if they don't see significant price appreciation, that probably is a good thing, as that means we haven't hit a hyperinflation scenario. In those cases, I would expect the majority of the portfolio invested in quality stocks and businesses to continue growing and performing well to generate you wealth long term. Again, understand in the short term that the price of these assets is likely going to be volatile and the returns inconsistent. But if you understand the long-term thesis for owning these assets, they can be an additional layer of protection against more tail-end risk inflation scenarios. So that is my 3-step plan for protecting my investments from inflation. Hopefully that gives you a bit of a framework for thinking about how you want to structure your portfolio to best help protect against inflation long term. More content like this is coming, so make sure to subscribe to gain access to that. And until then, thank you so much for watching. My name's Michael, and I will see you in the next video.